Hello there. Welcome to a brand new adventure, one that's all about exploring the fascinating world of swing trading. Whether you're completely new to trading or just curious about how it all works, you're in the right place. Ready for a little trip into the world of trading? Think of this as packing your bags for a journey where you'll discover new ideas, learn important skills, and maybe even surprise yourself along the way. Don't worry, it's not as scary as it sounds. In fact, swing trading can be a lot of fun once you get the hang of it. We'll take it step by step so you never feel lost or overwhelmed. Think of swing trading like making a clay character. It takes patience, a plan, and a steady hand. Each trade is like shaping a new figure, carefully crafting your moves and decisions. Swing trading means holding a trade for a few days or weeks, waiting for a nice, gentle move in price. It's not about rushing or chasing every little up and down, but about spotting opportunities and letting them play out. The key to all of this? Risk management, your safety net in trading. Just like you wouldn't walk a tightrope without a net, you shouldn't trade without a plan to protect yourself. It's about protecting your money so you can trade another day. Not just guessing and hoping for the best. Good traders always think about what could go wrong and make sure they're ready for it. Imagine building a rocket. You wouldn't launch without safety checks. In trading, those checks are your stop losses, your position sizes, and your rules for when to get in and out. Risk management is your control panel. It gives you the power to make smart choices, adjust your strategy, and stay in control no matter what the market does. It lets you step away from the screen without worrying your account will vanish. You can enjoy your day, knowing you've set things up to protect yourself. So grab a comfy chair and let's get started on this adventure. Make yourself at home, because learning to trade is a journey best taken with a clear mind and a relaxed attitude. We'll learn how to be smart, careful traders. We'll study the basics, look at real examples, and build up your confidence one step at a time. We'll look at the tools that help us protect our money and lock in profits. From charts and indicators to simple checklists, you'll see how traders make decisions every day. By the end, you'll feel more confident about making your first moves. You'll know what to watch for, how to manage your risks, and how to keep your cool when things get exciting. With a bit of know-how, anyone can learn to navigate the markets. So, let's set off together and see what the world of swing trading has in store for us. Let's talk about our two most important tools, the stop loss and the take profit. A stop loss is your emergency brake. It automatically sells if the price drops too far, protecting you from big losses. The take profit is your finish line. When the price hits your target, it sells for you and locks in your gains. These two work together like a perfect double act. The stop loss protects your capital, while the take profit makes sure you actually enjoy your profits. You set both when you enter a trade, so you have a clear plan from the start. Why are they brilliant? They take emotion out of trading. No more panic selling or holding on too long out of greed. These orders follow your instructions no matter how you're feeling. You make decisions with a clear head based on your plan. That's the secret to staying calm and collected. Where do you put your stop loss? It's a question every trader faces, whether you're just starting out or you've been in the game for years. The answer isn't as simple as picking a random number or following a hunch. In fact, the placement of your stop loss can make the difference between a smart, controlled exit and an unnecessary loss. It's not random, it needs to fit just right. Think of it like tailoring a suit. You want it snug enough to look sharp but not so tight you can't move. Your stop loss should be tailored to your trade, fitting the unique shape of the chart and the market's recent moves. Too tight, and you're out of a good trade. Too loose, and you risk too much. It's a delicate balance. If your stop is too close, even a normal price wiggle can knock you out. Too far, and you're giving up more than you need to. The best way is to look at the chart for support, a price level where the stock has bounced up before. Support is like a floor that's held up the price in the past, showing where buyers have stepped in. Find a trade you like, then look for the most recent solid support level. This is your reference point, the place where the market has already shown its hand. Place your stop loss just below that floor, giving it a bit of breathing room. Don't crowd the line. Leave enough space for the price to move naturally without triggering your stop on a minor dip. Why just below? Sometimes the price dips and bounces back. If your stop is right on the line, you might get kicked out too soon. Markets aren't perfectly precise, they can overshoot support before reversing. A little cushion helps avoid that. It's like adding extra padding to your safety net so you're not thrown out by a harmless bounce. This way, you're only taken out if the price truly breaks through support. That's your signal that the trade idea might not be working anymore and it's time to step aside. So, recap, find the last significant low or support and set your stop loss a sensible distance below. The distance depends on the stock's volatility and your own risk tolerance. Don't guess, let the chart guide you. Use what you see, not what you hope for. The chart is your map, and support levels are your landmarks. It's a logical, repeatable process. Once you get the hang of it, you'll find it becomes second nature, part of your trading routine, just like checking the weather before heading out. That's how you protect yourself without missing out on good trades. You're not just avoiding losses, you're giving your trades the room they need to succeed. Just like following a recipe for a good cheese scone, the right ingredients and careful steps lead to the best results. Take your time, measure carefully, and your stop loss will be right where it needs to be. Now for the fun part, planning your take-profit target. Instead of a floor, look for a ceiling resistance, where the price has struggled to go higher. Find a recent high or a level where the price turned down before. Set your take-profit just below that resistance so you're more likely to get your order filled. It's better to secure a good profit than miss out waiting for perfection. Another smart way, use a risk or reward ratio. If you're risking £1 per share, aim for at least £2 profit, a 1-to-2 ratio. This way, even if you're right only half the time, you can still come out ahead. It's simple maths that keeps your trading sensible. Set your target, stick to your plan, and let the market do the rest. That's how you lock in your wins. You might wonder, can't I just watch the screen and decide when to sell? It seems simple enough. Just keep an eye on the price and act when you feel it's right. But in reality, trading is rarely that straightforward. You could, but it's stressful and risky. The markets move fast, and it's easy to get overwhelmed or make a snap decision you regret. Sitting in front of your screen all day, second-guessing every move, can quickly drain your energy and confidence. These orders protect your capital. Your trading money is your most important asset. Without it, you can't participate in the market at all. Think of your capital as the foundation of your trading journey. Protecting it should always be your top priority. A stop loss is your promise to never let one bad trade wipe you out. It's like having a safety net in place, so even if things go wrong, you live to trade another day. This simple tool can mean the difference between a minor setback and a devastating loss. They're also your shield against emotions. Fear and greed can ruin good trades. When the market gets volatile, emotions can take over, leading to impulsive decisions. Having orders in place helps you stick to your plan, no matter what your feelings are telling you in the moment. By setting your orders before you enter, you make logical decisions with a calm mind. You're not reacting to every tick of the market. You're following a strategy you've thought through in advance. This approach helps you stay focused and reduces the temptation to chase losses or get greedy. Think of yourself as the director. Your stop loss and take profit are your crew, following your instructions. You set the plan, and your orders execute it, even if you're not watching every second. This teamwork lets you manage trades efficiently and consistently. This frees up your time and keeps you from being glued to the screen. You can step away, relax, or focus on other things, knowing your trades are managed. It's a healthier, more sustainable way to trade. Using these orders builds discipline, the key to long-term success. Discipline is what separates consistent traders from those who burn out quickly. It's about sticking to your rules, even when it's tempting to break them. Every successful trader has rules and sticks to them. They don't leave things to chance or emotion. Instead, they rely on a system that's been tested and refined over time. By always setting stop loss and take profit, you create a structured, professional approach. This structure helps you treat trading like a business, not a game of luck. You're not gambling, you're managing your business. Each trade is a calculated decision, not a roll of the dice. This mindset shift is crucial for anyone who wants to trade seriously. This discipline turns trading into a potential source of income. Over time, small, consistent gains can add up, helping you reach your financial goals. That's how you navigate the ups and downs with confidence. With the right orders in place, you're prepared for whatever the market throws your way, and you can trade with peace of mind. Even the best traders make mistakes, but the trick is to learn from them. One common blunder: moving your stop loss further away when a trade goes against you. Don't do it. Treat your stop loss as sacred. Another mistake: canceling your take profit out of greed. Stick to your plan and bank your profits. Don't set your stop loss and take profit based on random amounts. Let the chart guide you. Place your stop based on support or resistance, then calculate your position size to match your risk, and never skip using these orders. Every trade needs a stop loss, no matter how confident you feel. It only takes one surprise to wipe out your account. Using stop loss isn't weakness, it's what professionals do. Avoid these blunders and you'll be ahead of most beginners. Stick to your plan, trust your analysis, and protect your capital. That's how you last in the trading game. Let's share a few crafty tips to make your trading even smarter. First, try a trailing stop loss. It moves up with the price, locking in profits as you go. If the price turns, your stop is already higher, securing gains. Always check your risk-reward ratio before entering a trade. If the potential profit isn't at least twice the risk, walk away. Keep a trading journal. Write down why you entered, where you set your orders, and what happened. Review your trades to spot patterns and learn faster. And above all, be patient. Swing trading isn't about constant action. Wait for setups that meet your rules. Don't force trades out of boredom. Patience is a superpower in trading. A good trader waits for the right moment, like a sculptor with the perfect piece of clay. Stick to your process and you'll see better results. Smart habits make all the difference. Let's imagine a trade with Wensleydale Cheese Company. The price chart shows a gentle uptrend, bouncing off £10 support and struggling at £13 resistance. We wait for the price to dip near support, say £10.50. Before buying, we set a stop loss just below support at £9.80, risking 70 pence per share. For take profit, we aim just below resistance at £12.80, for a potential gain of £2.30. That's a risk-reward ratio of more than 1 to 3, fantastic. We buy at $10.50, set our orders, and let the trade play out. Now we can relax. Either we take a small, managed loss or a planned profit. We've taken control with a clear plan. No guessing, no stress. This is how you turn chaos into a structured operation. That's the magic of smart trading. With a plan, you're ready for whatever happens. And that's how you trade like a pro. That's our grand tour of stop losses and take profits. It's all about having a plan. These tools are your best friends in trading. Always set your stop loss below support and your take profit below resistance. Check that your potential reward is worth the risk before you jump in. These simple rules set you apart from most beginners. Keep your risks small, use a journal, and be patient with yourself and the market. Your goal isn't to get rich overnight, but to learn a skill for the long term. Enjoy the process and keep improving. Start small, be sensible, and always use your trusty stop loss and take profit. With practice and common sense, you'll trade with confidence. Now, who's for a nice cup of tea and a bit of Wensleydale? Cheerio.